I'm Ruth.
I'm Xavier. I'm Tristan. And
We are the group 9 of Section Agomaa.
Agomaa.
And today we're going to discuss what is taxation all about.
Why do we have taxes? What did they do for us?
Classification of taxes.
Types of taxes and the principles of taxation.
Tax is an amount of money levied by a government and its citizens and used to run the government, the country, states, or a municipality. Don't you know that taxation is a system of raising money to finance the government? All governments require payments of money, or what we call taxes. Government use revenues to pay soldiers and police, to build dams and roads, to operate schools and hospitals, to provide food to the poor and medical care to the elderly, and for hundreds of other purposes. So, without taxes to fund its activities, the government could not exist.
Did you know that there are three main reasons why is it important for every citizen to pay taxes? The thought, why I should pay income tax, might have crossed your mind at least a few times, especially while going through your salary slip or filing tax returns. As taxes can eat up a considerable portion of your salary, it is prevalent for many people to believe that taxes are nothing but a burden. But is it truly the case? Not really. Let us have a look at the importance of income tax. Without taxes, governments will be unable to meet the demands of their societies. Taxes are crucial because governments collect this money and use it to finance social projects. Some of these projects include health, education, and governance. Health. Without taxes, government contributions to the health sector would be impossible. Taxes go to funding health services such as social healthcare, medical research, social security, etc. Education. Education could be one of the most deserving recipients of tax money. Governments put a lot of importance in development of human capital, and education is central in this development. Money from taxes is channeled to funding, furnishing, and maintaining the public education system. Governance. Governance is a crucial component in the smooth running of country affairs. Poor governance would have far-reaching ramifications on the entire country with a heavy toll on its economic growth. Good governance ensures that the money collected is utilized in a manner that benefits citizens of the country. This money also goes to pay public servants, police officers, members of parliaments, the postal system, and others. Indeed, with a proper and functioning form of government, there will be no effective protection of public interest. Other important sectors are infrastructure development, transport, housing, etc. Classification of taxes. Taxes may be proportional, progressive, regressive, and digressive. First, proportional tax. A proportional tax takes the same percentage of income from all people. A proportional tax is one in which whatever the size of income, same rate or same proportional percent is charged. If all taxpayers have to pay to say 1% of their income, as the tax is known as the proportional tax. Second, progressive tax. A progressive tax takes a higher percentage of income as income rises. Rich people not only pay a larger amount of money than poor people, but a larger fraction of their incomes. The principle is the higher the income, higher the rate. Third, regressive tax. A regressive tax takes a smaller percentage of income as income rises. Poor people pay a larger fraction of their incomes in taxes than rich people. It is the opposite of the progressive tax. Fourth, digressive tax. A tax is called digressive when the higher incomes do not make a due sacrifice, or when the burden imposed on them is relatively less. So there will be a lower relative sacrifice on the larger incomes than on the smaller incomes.
Types of taxes. First is individual income tax. An individual income tax, or also called as a personal income tax, is a tax on person's income. This includes wages, salaries, and other earnings from one's occupation. Example of this is interest earned by saving accounts, and certain types of bonds, such as rents, royalties, earned on sales of patented copyright items such as inventions and books, the dividends from the stocks, and it also includes capital gains, which are profit from the sale of stock, real estates, or other investment which values has increased over and over time. Second is corporate income tax. The corporate income tax is one of the most controversial type of taxes. It leads to double taxation of corporate income. Income is taxed once when it is earned by the corporation, and the second time when it is paid out to shareholders in the form of dividends. Thus, corporate income faces a higher tax burden than the income earned by individuals or by other type of businesses. Some economists have proposed abolishing the corporate income tax and instead taxing the owners of corporations or the shareholders through the personal income tax. Payroll tax. Payroll tax applies only to wages and salaries. For most people, payroll taxes are the second largest tax they must pay each year after individual income taxes. Employers automatically withhold payroll taxes from employees' wages and forward them to the government. Payroll taxes are the main sources of funding for various social insurance programs, such as those that provide benefits to the poor, elderly, unemployed, and disabled. Next is consumption tax. When we talk about consumption tax, it is a tax levied on sales of goods or services. The most important kind of consumption taxes are general sales taxes, excise taxes, value-added taxes, and tariffs. General sales taxes and excise taxes are the largest sources of revenue for state and local governments for a number of countries. General sales tax. General sales tax imposes the tax on a wide variety of goods and in some cases or services. Although sellers are legally responsible for paying sales taxes, and sellers collect sales taxes from consumers, the burden of any given sales tax is often divided between sellers and consumers. Sample of goods that may be subjected to excise taxes includes tobacco products, alcoholic beverages, gasoline, and some luxury items. Excise taxes are applied either on a per unit basis, such as per package of cigarette or per liters or gallons of gasoline, or also fixed percentage of the sales price. Value-added tax, or what we call VAT. In this system, the seller pays the government a percentage of value added to goods or services at each stage of production. The value added at each stage of production is difference between the seller's cost for materials and the selling price. In essence, a VAT is just a general sales tax that is collected at multiple stages. Tariffs, also called duties or custom duties. These are taxes levied on imported or exported goods. Import duties are considered consumption taxes because they are levied on goods to be consumed. Import duties also protect domestic industries from foreign competitions by making imported goods more expensive than their domestic counterparts. Property tax. In principle, a property tax is a tax on an individual's wealth. The value of all of person's assets, both financial, including stocks and bonds, and real, such as houses, cars, and artwork. In practice, property taxes are usually more limited. We also have the state, inheritance, and gift taxes. An estate tax is a tax on the deceased person's estate, which includes everything the person owned at the time of death, just like the money, real estate, stock, bonds, proceeds from the insurance policies, and the materials possession. Most governments levy state taxes before the deceased person's property passes to heirs. Although many governments do not impose an estate tax on property inherited by a spouse. An inheritance tax also taxes the value of the deceased person's estate, but after the estate passes to heirs, the inheritors pay the tax. Estate and inheritance taxes are sometimes collectively called death taxes. A gift tax is a tax on the transfer of property between living people.
Today's economists have rather different ideas of what constitutes a good tax system. Most believe that a tax system should follow two main principles: fairness and efficiency. Fairness. Economists consider two principles of fairness to determine whether the burden of a tax is distributed fairly: the ability to pay principal and the benefits principle. Ability to pay principal. The ability to pay principal holds that people's taxes should be based upon their ability to pay, usually as measured by income or wealth. One implication of this principle is horizontal equity, which states that people in equal positions should pay the same amount of tax. Fairness is often the enemy of simplicity. A second requirement of the ability to pay principle is vertical equity, the idea that a tax system should distribute the burden fairly across people with different abilities to pay. This idea implies that a person with a higher income should pay more in taxes than one with less income. But how much more? Should families with different incomes be taxed at the same rate or at different rates? The benefits principle. The benefits principle of taxation states that only the beneficiaries of a particular government program should have to pay for it. The benefits principle regards public services as similar to private goods and regards taxes as the price people must pay for these services. The practical application of the benefits principle is extremely limited because most government services are consumed by the community as a whole. Efficiency. In addition to being fair, a good tax system should be efficient, wasting as little money and resources as possible. There are three measures of efficiency. First, administration costs. Second, compliance costs. And third, excess burden. Administration costs. Running a tax collection authority costs money. The government must hire tax collectors to gather revenue, data entry clerks to process tax returns, auditors to inspect questionable returns, lawyers to handle disputes, and accountants to track the flow of money. No tax system is perfectly efficient, but the government should strive to minimize the cost of administration. Compliance costs. Complying with the system paying taxes cost taxpayers money above and beyond the actual tax bill. These costs include the money that people spend on accountants, tax lawyers, and tax preparers, as well as the value of taxpayers' time spent filling out tax returns and keeping records. Excess burden. The third measure of a tax system's efficiency takes into account the fact that when the government levies a tax on a good, it distorts consumer behavior. People buy less of a tax goods and more of other goods. Instead of choosing what goods to buy solely on the basis of their intrinsic merits, consumers are influenced by taxes. This tax-induced change in behavior is called an excess burden. The larger the excess burden of a tax, the worse it is for efficiency.